Everyone has the same question right now. We've been seeing the reporting on major escalation involving US and Israeli strikes in Iran. So naturally, the question from millions of investors becomes, what does this mean for the market? I'm Christiana Lovelace. I'm a licensed financial advisor and accredited asset management specialist, and I own Diamond Point Financial. First, an important distinction. An attack or series of strikes is not automatically a war in the formal economic sense. But markets tend to care less about labels and more about details, particularly the scope and duration of these strikes. 1 week focused in the Middle East is much different than 1 month with retaliation throughout parts of Europe. Spillover risk also becomes an issue. Right now, investors are watching energy supply, global trade routes, defense sectors, and policy responses very closely. Markets typically react fast, but they also adapt quickly. Geopolitical shocks often create an initial drop, a volatility spike, and a rush to perceive safety. But historically, that reaction tends to level off faster than most people expect, even when the event itself feels severe. Take a look at this chart from Clearnomics. It shows major geopolitical events and movements of the S&P 500 up to a year after each event, including returns at 3 months, 6 months, and 12 months. Keep in mind, every situation is unique, and there is no guarantee of how markets will respond this time. But broadly speaking, when researchers evaluate historical geopolitical and military events, the median S&P 500 return has been positive more often than not at those timeframes. Based on these 8 events, average returns at 3 months following the event were 4.24%. At 6 months, it was 5.38%, and at 12 months later, the average return is over 10%. Of course, we can't use previous returns to predict future gains, but in terms of market behavior, once uncertainty transitions into clarity, even if it's unwanted clarity like war, markets begin reallocating capital based on these new expectations. And an unfortunate truth is that if war is officially declared, it can trigger increased government spending, typically acting as a short-term stimulus for defense-related industries, and it can boost GDP. It's referred to as the war economy, and without diving deeper into it now, just keep in mind that it can bring on its own host of issues. So what should you do with your portfolio right now? First, knee-jerk changes during breaking news are rarely strategic. By the time fear is loud enough to trend, markets have already repriced the risk. Reactive selling can turn temporary volatility into permanent loss, and that's not the objective. For most of our clients, portfolios were already structured for volatility, and we have continued adjusting as conditions evolved. And if a change is warranted, they have already heard from me directly. If conditions stabilize and recovery opportunities start to emerge, we can adjust then. It's important to keep in mind we can position before events or after them, but during active uncertainty, patience is often the most disciplined approach. What else can you consider doing during this time? Periods of volatility can create opportunities, particularly for new capital, depending on your situation and your long-term objectives. And in some cases, strategic tax planning opportunities, such as Roth conversions, may be considered during market pullbacks. But that decision must be personalized and aligned with your broader financial plan. I mention these possibilities simply to remind you that volatility does not automatically mean danger. History shows that markets tend to digest geopolitical shocks faster than our own emotions do. If you're feeling uneasy, that's human. But we do not manage money from emotion. We manage it from structure. If you have personal questions or concerns about your situation, please feel free to reach out. I will continue monitoring developments closely. And for now, I want you to stay objective, stay disciplined, and allow the market to do what it has historically done. It reprices, recalibrates, and it moves on.